If you are the kind of person who needs to get up to speed on a complex field fast, I mean, maybe you've just landed a new role or you're cramming for a huge meeting, you definitely know the frustration that corporate finance can create.
Oh, absolutely.
We talk about accounting, finance, and treasury, and, they feel like three separate languages spoken in three different silos.
And people assume the materials is complicated because the concepts themselves are difficult.
Exactly. But after going through your sources, we realize something key. It's hard because of the jargon. Nobody just stops to explain these functions in plain English, starting from the ground up.
They really don't.
So today we are changing that. We're doing a deep dive into Principle 1 of the 7-layer Treasury framework. Our mission is, well, it's clarity. We are going to permanently distinguish these three essential financial functions and show exactly why one of them, Treasury, is not just important, but the absolute silent key to a company's day-to-day survival.
And the stakes here are really high because the difference between understanding these roles and confusing them is the difference between a business that operates with certainty and one that is just constantly scrambling for the next payroll.
So we're focused on that core question. What happens when we zoom out from, say, a simple piggy bank to the pressure cooker of the corporate boardroom?
That's the leap we need to make.
To do that, we have to start at layer 0, the analogy. So let's meet Ria. She's 10 years old, loves to read, and she's our chief financial officer for her 500 weekly pocket money.
A very important role.
It is. And Ria does 3 essential things with her money. First, she writes down every single expense in her little notebook, that hero for ice cream, the 100 she lent a friend.
The official record.
Second, she checks the actual balance in her piggy bank to see what's really available right now. And third, she's constantly making decisions. Can I afford this big book today, or do I have to wait to make sure I have enough for the school trip next week?
And that little framework is layer 0 gold. If you map Ria's actions directly onto the professional world, the roles just become crystal clear. Ria writing down her expenses.
That's accounting.
That is accounting. Accounting is the historian of the company. It's meticulous, it's backward-looking, and it records every single financial event, every invoice, every receipt. It's the definitive ledger of what already happened.
Okay, so then Ria checking her piggy bank balance, that immediate state of affairs, that must be finance.
Precisely. Finance is the analyst, the storyteller. It takes that raw historical data from accounting and asks, how well did we do? It's looking backward and at the present, analyzing profit margins, budget variances, all of that. It turns the data into insight.
And Ria looking ahead, deciding whether to risk buying that toy today or just wait. That's the whole ballgame for Treasury.
That's it.
Treasury is purely forward-looking. It asks the one critical question, will we survive tomorrow morning? This function owns cash, liquidity, payments, borrowing, investing, risk. If Ria runs out of cash, her operation just stops. The same thing happens to a company.
And before we go any further, we should probably nail down some of that jargon. There's a quick translation guide. When Treasury talks about cash, they mean money you can touch and use right now.
Not theoretical money.
Not at all. And payments is the actual mechanism, moving money out the door with all the bank infrastructure and fraud checks that go with it.
Okay.
But the most important term is liquidity. This isn't just how much cash you have. It's your specific ability to pay your bills the moment they show up without scrambling. A company might look profitable on paper. That's a finance view. But if Treasury doesn't manage liquidity, they could still default on payroll.
That distinction, profit versus liquidity, that's everything. Now, here's where I think most people get confused. They assume these 3 functions, let's call them the AFT team, they work in a sequence.
Right, the traditional textbook flow.
The official flow, yeah. Accounting feeds the books to finance, which reports on performance, and then Treasury uses that data for strategy. But your sources say that's completely backward when it comes to the decisions that really matter.
It is. The real-life flow, the sequence where critical decisions are actually made, is totally flipped. It runs Treasury finance accounting.
Wait, that completely upends what I learned in business school. Why is Treasury the driver? Is that an oversimplification, or does the CFO truly put immediate survival over, say, the P&L statement?
They absolutely prioritize survival. When the CFO wakes up worried, they aren't losing sleep over a variance report from last month.
Yeah.
Their number one anxiety is, can I make that huge supplier payment tomorrow, and can I fund the entire payroll on Friday?
That's a cash and liquidity question.
Purely. It's Treasury's mandate. The entire organization's focus pivots around Treasury's ability to say, yes, the cash will be there.
That makes perfect sense. The finance department can't build a profitable strategy if the company collapses tomorrow from a lack of operating cash.
Exactly. And this leads us right into the crucial Treasury concept chain, which is the mechanism that links it all together. It starts with the most immediate thing, cash position.
Mhm.
Can we pay our bills today? That information is then used to build the liquidity forecast. So, based on expected cash in and out, can we cover next week, next month?
And that forecast is the pivot point, right?
Right.
Once Treasury knows if there's a surplus or a deficit, they move into the funding strategy.
That's the decision point. Do we need to borrow money, or do we have extra cash we should invest to earn some yield?
Then comes the actual borrowing or investment decisions, where they're balancing cost, risk, speed.
Right. And after that decision is made, Treasury manages the detailed execution of payments, making sure the money moves correctly, safely, with all the approvals. And finally, that movement, the payment or the investment, is logged for its accounting impact. That's where you get the final official record.
What's so fascinating here is that Treasury acts as this real-time nerve center.
It does. It touches every single part of the financial life cycle,
Mhm.
and it owns the risk nobody else wants to talk about, that immediate risk of just failing.
Let's see this in action, because the way Treasury operates under pressure is where you really see the magic. We're moving to layer 3, the real-life CFO stories, where Treasury often saves the day before anyone else even knew there was a problem.
Let's start with the classic 9.05 a.m. cash question. The CFO walks in and asks the team for the global cash position. What can we use right now?
And accounting can only tell you what the books look like at midnight yesterday.
Right. The reports are static, and finance might say, well, according to the budget, we should be fine.
But Treasury delivers the actual truth. They don't just give a bank balance. They say, we have 42 million in available funds, but 18 million is blocked in an escrow account from an old deal, and another 6 million is in a volatile market and has regulatory risk. So our net free usable liquidity is actually 24 million.
And that is the critical distinction. Only Treasury sees the money dynamically. They track all the restrictions, the blockages, the things that stop funds from being instantly available. Accounting records the numbers. Treasury knows their usability.
That level of detail is incredible. It changes a comfortable 42 million into a critical 24 million. So let's look at the famous 10 a.m. liquidity call the moment Treasury prevents total chaos.
Okay, picture this. It's a Thursday. Treasury gets 3 simultaneous alerts. A huge supplier payment is due today, Friday's payroll is massive, and there's a tax deadline looming. A junior analyst might just panic and say, hit the bank overdraft now.
And what does the real Treasury team do?
Because they have that forward-looking forecast, they know exactly where their internal surpluses are. So they calmly decide, instead of paying overdraft fees and maybe hurting our credit rating, we're going to execute an internal sweep of 15 million from our European subsidiary. The move will happen by noon.
That's the magic. They avoided external borrowing completely, but why is that internal sweep so much better?
For so many reasons. First, external facilities, they have fees, high interest rates, maybe 11.5%. Second, pulling from an internal surplus is faster, no external paperwork. And third, and this is the strategic part, it saves the company's external borrowing power for a real, unexpected crisis.
Right. They solved a funding gap while keeping their emergency options open.
Exactly. That strategic flexibility is why Treasury is a value driver, not just a control function. And you see it even more clearly in funding decisions. Let's say the company needs 50 million. The bank offers a standard overdraft at 11.5%, but Treasury finds they can issue commercial paper at 8.9%.
Accounting just records the interest payment later on. Finance budgets for it.
But Treasury makes that decision before lunch and saves the company 2.6% on 50 million. That's thousands of dollars every single day just by knowing the difference between the available path and the optimal path.
That distinction, available versus optimal, is huge. And then there's the currency risk, the FX hedge scenario. The markets move 3% overnight, and suddenly an export contract loses 2 million in value.
So finance explains the variance. Global volatility. Accounting records the 2 million loss. But the conversation dies there, unless Treasury steps in. Treasury is the one who explains why that exposure was successfully hedged at 80%, meaning most of that loss never actually hit the bottom line. Or maybe why the strategic decision was made not to hedge that one.
So Treasury brings strategy and foresight to a situation where everyone else is just using hindsight or assigning blame.
Precisely.
And this is where it gets really interesting for me, because this kind of thinking isn't just common sense, it's quantifiable logic that saves real money. Which brings us to layer 4, the measurable savings.
Yes.
Let's go back to that mini case. The company needs 15 million for just 5 days. If they take the easy route, the overdraft at 11%, The cost is about 13,500.
But if Treasury does its job, finds that internal pool, and executes the intercompany sweep, the operational cost might only be 3,500. They've just saved over $10,000 in 5 days, simply by choosing the cheapest, safest path. They're always thinking about the marginal cost of funds.
And this method has to work no matter what tools you're using. That's layer 5, right? The system agnostic mapping. The idea is learn the concepts first, master the tools second.
That's the golden rule. The systems change constantly. Today it's SAP, next month it's Kyriba, in a year it could be some AI bot doing predictive modeling. But the core concepts, cash position, liquidity forecast, risk management, those never change.
That's so empowering for anyone listening, you realize. Great treasurers survive system migrations because they understand the why. If you only know how to click the buttons on one piece of software, you panic when IT announces an upgrade because you only know the tool.
Exactly. And that conceptual strength is all formalized in Layer 6, the Treasury problem-solving DNA. When liquidity issues hit, they don't use a gut feeling. They use a system, what they call the 6-step consultant lens.
Okay, that 6-step lens sounds like the holy grail for preventing financial panic. Walk me through the evaluate step again. What are they always weighing there?
Okay, so the process starts with identify where is the cash crunch coming from. Then analyze the variables: timing, currency, risk. Then quantify the exact amount. Then you hit the step you asked about, evaluate.
The big one.
This is where they weigh the core choices. Should we fund this with debt? Should we try to delay the payment? Or should we mitigate the risk with a hedge? They're constantly weighing cost against control.
So after that evaluation, they figure out the best path forward.
Right. They recommend the safest, cheapest path based on the cost of funds and the company's risk tolerance. And finally, they execute the strategy and close the loop, logging the result. It's why million-dollar problems get solved before the CEO has even finished their morning coffee.
So what does this all mean? We've reached the fundamental truth of this module. When we talk about the AFT team, it really comes down to their mandates.
Yes.
Accounting isn't mandated to track real-time liquidity, and finance isn't responsible for the daily execution of payments. Treasury owns that specific, immediate risk of operational failure.
That's the bottom line. Accounting remembers the past. They create the ledger. Finance explains the present performance. But Treasury protects the future every single morning by ensuring the company can meet its obligations no matter what surprises come along.
And that's really the knowledge we want you to take away.
It is. When the Treasury function is strong, operational certainty follows, and CFOs can actually sleep at night. When those core concepts, cash position, liquidity management, optimal funding, are mastered, the entire financial structure moves from reactive scrambling to proactive strategic planning.
That distinction between just recording something and actually deciding something is enormous. Accounting records that the company spent money on interest, but Treasury is the function that decided if that number, that cost, should have even existed in the first place.
So the next time you look at your own budget or you're making a big personal financial decision, just ask yourself this: are you just recording what already happened? Or are you applying a little bit of Treasury foresight to protect your future plans? That strategic, forward-looking mindset. That's the real power here.